And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to The Real Investment Show. Of course, it is Hump Day and it is also Fed Day. And today is the much anticipated Fed meeting. Will they come out and cut rates today? By how much? That's the whole question the market wants to know. This morning futures are, a little bit flat, a little bit down, depending on which index you're looking at. Yields are a little bit lower this morning, kind of in anticipation of that. Of course, the markets have already priced in a 25 basis point rate cut. That's been going on now for the last really kind of 2-3 weeks as we've had kind of this rise in the markets. The real question today will not come down to the rate cut. That's pretty much already baked into the cake. The real mover for the market will be what the Fed actually says in that meeting, and particularly in the press conference. So they'll have the meeting cut out, and of course Jerome Powell will go do his press conference. That's where we'll get some details about what their positioning actually looks like. Yeah, we're cutting rates, but maybe this is only one rate cut this year. Or hey, we're starting to see a lot of weakness in the economy to cut rates more. Whatever that says, and particularly the changes that are made, everybody's going to scrutinize the statement. And remember that FOMC statement that gets published just following the meeting, that statement is always the same. And all they do is just revise some wording within that statement. It's very carefully crafted. It's not the actual minutes of the meeting, but it's their statement. And basically, they just are changed. So we're going to be everybody's going to dig down to this and say, okay, well, what do they say about employment? Employment was robust, but now is it moderating or is it weakening? What are they saying about the economy? Is it robust or is it getting weaker? Those are going to be the key words that everybody's looking for in that statement to help kind of forecast what to expect for Fed policy going into the end of this year. Is it going to be one rate cut and a pause? Is it going to be rate cuts at every meeting? That's what the market's looking for. And what the markets have been pricing in is at least 2 rate cuts this year, if not 3. So anything that disappoints that will likely lead to some type of sell-off in the market. So just, again, don't expect a lot of fireworks today, but again, there's always the risk out there, particularly with markets pretty elevated here. Money flows have been very, very strong. So again, we'll get into that in a second. We'll talk about the before the bell, but we're seeing a lot of risk asset chase. Everybody's chasing assets of, pretty much every ilk right now. Pushing prices really to extremes on a lot of levels, not just on a daily basis, but also on weekly and monthly basis as well. A lot of assets are getting really, really extended because of this chase, and that's the real risk. So again, just kind of pay attention to the markets today. We'll see what happens, and then we'll tomorrow morning, when we're here talking about it, we'll kind of catch up, see what the Fed said, get more into that detail tomorrow. So here's what you do need to know before the bell this morning. Again, heading into that Fed meeting today, stocks are really poised very well. They're very extended. We're overbought on multiple levels. So the real risk today is downside rather than upside. Again, markets have already priced in pretty much everything positive the Fed could possibly say. So there's risk for disappointment coming out today because of that extension. Money flows have been very strong chasing these stocks. And in particular, while money flows have been chasing kind of the market itself, it's really been the most shorted stocks that have had the strongest rallies. Those have really been pushing up hard here. Also, Friday is a record options expiration day. So again, we're going to see a lot of rotation, potentially volatility in the markets between today and Friday. Also, just getting ready for that all those options expirations. But it's not just the S&P that's been traveling kind of like this as of late. We continue to see a lot of the same type of push, very big deviations above moving averages, etc., particularly in some of the more high-risk area. Emerging markets, as an example, have had just a stellar run here just over the last couple of weeks. There's been a big surge of money flows chasing emerging market stocks. These are very heavily weighted in Chinese technology stocks. So that's really been pushing EM here as of late, but very, very overbought. Typically, when you're this overbought on emerging markets, you typically get a correction. But, again, this has been a big laggard relative to the S&P. This year, it's doing okay, but over the last 10, 15 years, emerging markets have been a huge laggard to just owning domestic stocks, but getting a little bit of sign of life here. But again, this deviation is getting to be a record for emerging markets. So again, this is a really good place to think about taking some profits, rebalancing some risk. International stocks also trading well above their moving averages, not as overbought as emerging markets. Again, they don't have the Chinese technology stock exposure that emerging markets does, but international also trading very well above its means. The one kind of we talked about this morning in the daily market commentary, which I just published, is this continued gap in performance between S&P equal weight and S&P market cap weight. Again, the market's being driven by this handful of stocks. Emerging markets being driven by Chinese technology stocks, U.S. markets being driven by AI technology stocks, but a lot of the rest of the market really not performing all that well. So even though the markets at the headline look they're doing great, internally they're not that healthy of a market. So again, we're continuing to see this bit of breadth. You're seeing relative strength declining. You're seeing momentum declining on equal weighted indexes. But again, just the opposite when you look at market cap weighted because of that weighting of those top 10 stocks. Also too, just talking about bond yields, this is going to be one of the things that are going to be a focus in the markets today. Bond yields continue to drop here as the Fed cuts rates. So again, as we talked about before, as the Fed cut rates, so go Fed rate cuts, so go longer end yields. And those are going to continue to kind of track each other. Markets are starting to price in rate cuts, both on the 2-year Treasury rate, which is about 80 basis points lower than where the Fed funds is right now. That gap will close a little bit today with a Fed rate cut. But again, markets have already been preempting in the bond market, have been preempting these rate cuts. So again, as we continue to cut rates, you're going to expect to see lower yields, and generally that's going to coincide with slower economic growth. But see, there's the interesting dichotomy, and this is what we're going to talk about with Danny Ratliff today, is that the markets are banking on tax cuts and Fed rate cuts, and the bond market's telling you there's a problem with the economy. So which one's right? We'll talk about that next with Danny Ratliff. But that's what you need to know before the bell this morning. When we come back, we'll pick up Danny Ratliff. Don't go away.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
If you're 65 in 2025, Medicare will be a part of your life from now on. What do baby boomers need to know about Medicare? Richard Rosso and Danny Ratliff present our next dynamic learning series on Savvy Medicare Planning. Thursday, September 18th, with answers to your questions about Medicare, when to enroll, and how to navigate the alphabet soup of Medicare. Register today for Savvy Medicare Planning, what baby boomers need to know about Medicare. September 18th with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning. Danny Ratliff joining me. Talking again, today is Fed Day. That's what everybody's kind of focused on right now. That's going to be the whole talk of today. The rate cut projections right now are pretty much pushing 3 rate cuts this year, but there's always the risk that you could see more rate cuts. But this is also kind of an interesting dynamics. Markets are rallying based on rate cuts, but also not just rate cuts, but a resurgence of economic growth going into next year. And this kind of idea that tax cuts are going to kind of continue to fuel profit margins. And I showed you the chart earlier this week of this big gap right now between profit margins and economic growth. And the reason that's important is that profit margins track economic growth. So the answer, kind of the math to the formula, so to speak, is if you can figure out where economic growth is going to be next year, that'll tell you where profit margins are going to be. And from there, you can start to factor in kind of what markets should be trading at based on those profit margins, which are a function of earnings and economic demand. So, it's just kind of an interesting dichotomy. We have clearly talked about just recently the slowing employment numbers that we have, very much a definite slowdown in employment. We're seeing some of the same impacts. Retail sales as a function, they're holding in, but they've been flat for the longest period ever on record for retail sales. Generally, retail sales rise with the economy. So if the economy's growing, retail sales should be rising. But if you look at retail sales, they've been flat for a very long time, a couple of years. So they're not really growing. They're just kind of maintaining where they are, which is keeping consumption in place. But we're not seeing a real strengthening in consumption. And then, of course, you factor this down and start looking at what fast food, casual dining restaurants have been saying, what we've heard from restaurants like Chipotle as of late and Cava talking about their foot traffic. We've talked about foot traffic in higher end retail stores. So there's a lot of indications that the consumer is slowing down, but what the markets are betting on is that this is all temporary and we're about to have a big resurgence in the economy, and that big resurgence in the economy will support earnings and will help justify current valuations in the markets. So this is the big question. I don't know the answer, right? Maybe Wall Street is right. Historically, Wall Street's always wrong, but on their expectations are always overly optimistic and things don't work out that well, but maybe they're right this time. So anyway, that's a little bit of the conversation Danny and I are going to have this morning. So Danny, what are your thoughts?
Well, that's the $1 trillion question right now, Lance. I mean, I think the question right now is that seems to be a lot of confusion amongst investors. And, just last night I was looking at topics today we could discuss, and it seems to be there's a ton of different reports suggesting nobody really truly knows what's happening. And I think that's the struggle that people have. And if they tell you they do with, 100% confidence, number one, they're full of it, because there are so many moving parts that are occurring right now. And, just this last month, CNBC's did a new survey. And essentially, they saw that 82% of respondents said that the Fed actions are designed to limit or eliminate central bank independence. 68% thinks the president's actions will put upward pressure on inflation, and 57% said it will result in higher unemployment, and 54% see lower economic growth. Mm-hmm. So the other side of this equation is, so you have these money managers, there's 29 large money managers that is what they believe. Higher inflation, lower growth. Okay?
That's all what the market's saying.
And more unemployment, correct. And the other side of that, the bullish argument, is essentially that's all behind us. None of this is going to be that bad. The employment numbers, which, by the way, were revised just over the last 2 years, 7 million?
1.8.
Yeah, 1.8. That's even worse.
Yeah.
So
we round up a little bit, but yeah.
Yeah. Now, retail sales revised positively. Not by a ton, but not bad. So showing that right now, evidently, tariffs are not really impacting the consumer. So all this data is really difficult, I think, when we start to look at it, piece by piece, and then paint this broader picture, because interest rates, like you mentioned, have been relatively resilient. Mm-hmm. They're not showing that, hey, we're falling off this cliff, but I think that's what everybody's expecting. And you've been talking about this for a while, and it's something we talk about internally. Is market is due for a pullback. If you look at any moving averages, how far above our moving averages are we at the moment? I mean, just from the 20-day, we're fairly deviated, right?
Yeah. No, the deviations are. I was just looking at some charts this morning, and we're talking about emerging markets and others, and a lot of these indexes are 3 standard deviations above longer-term moving averages, which, again, just to kind of put that in just really basic terms, stock prices can only move so far before they correct, and moving averages are like gravity, so to speak. And so as that pull becomes greater on prices, you're eventually going to get a correction back to the mean. And so when you talk about standard deviations, prices can only move so far in one direction before you get that. So it's kind of like stretching a rubber band. And in a lot of cases, whether it's gold or emerging markets or gold miners or the NASDAQ or most shorted stocks or small cap stocks, a lot of these are trading at 2 and 3 standard deviations above their moving averages. And that's just Bitcoin. These are just all just kind of signs that you've got a lot of exuberance in the markets, and you've got a lot of people betting that prices can only go higher from here. And maybe they're right.
and maybe prices will go higher from here, but probably not without some type of corrective action along the way. Now, I got a really interesting email about this morning, just as I was sending something, and just saying it's like, hey, well, I understand what you're talking about, and breadth as a function, we have what's called a breadth thrust going on in the markets right now, and that's a bullish kind of move. It just means you've got a lot of buying going into the markets, and those can last for a while, and suggest that we're going to continue to have this kind of upward bias at least through the end of this year. But that doesn't mean you're not going to get 3 or 5% corrections along the way. But the question is like, well, I hear what you're saying, but don't you think a bear market's going to start, kind of first part of next year? And that answer is no. If we're talking about a real bear market where you have a 20, 25% correction in the markets, 30% correction in the markets, we're probably not going to have that because we just had one in April. So you just had a 20% correction in April, and generally you don't get 20% corrections back to back in markets. So we're probably not due for another 20% correction for a while. Doesn't mean it can't happen, right? If something happens economically, we could certainly have that, absolutely. But given the status quo right now, if we just have slowing economic growth and the Fed cutting rates, 3 or 5 or 10% corrections are going to be very possible, and I would expect those. But a bear market, like one you really need to hunker down for and start, really getting very defensive about, probably not in the cards even into next year.
I mean, we're not even 3% away from the 20-day moving average. We're 4.5% give or take from probably the 50, and it may not even be that much. Actually, I need to go do the math. But we're 10% just from the 200-day moving average. So their average is for a reason, and like Lance said, it's kind of that gravity effect essentially is going to pull those back down over time. Now, one thing I'm hearing a lot from of people are thinking or suggesting is that we're going to have this melt up, and then we're going to fall off that cliff and it's going to be down 30, 40, 50%. And that argument, though, is that what data are you seeing outside of what you think is going to happen that suggests that is the case? Mm-hmm. Now, I think we could probably make an argument, and I'm thinking out loud here, so don't hold us to it. But if we did get this tremendous melt up, I would think that at the end of the year or very beginning of 2026, you're going to see a lot of people start to take chips off the table. And I think that would be a prudent thing to do.
Well, no, I disagree with that.
No, really?
Is that people won't. No, if you start getting a true melt up in the market, they'll be putting more chips into the market.
Yeah.
And this is very much like we saw in late 1998, 1999, where the NASDAQ was up 100% in a quarter. Because it's, once you start getting that herd mentality, right, that's going to suck more and more. You're going to suck more and more of that capital in. And the more aggressive that rise is, the more aggressively people will buy it. And the logic is that, maybe there's some logical people out there that go, hey, this can't last. I'm going to take some chips off the table. That'll be a few of the smarter investors will do that. But by and large, you'll have a force feeding of the markets as people pile in. And again, now more so than ever because people are buying ETFs, not individual stocks, and that just kind of fuels all of this rise in the markets. Yeah. But again, you're seeing these very, very sharp elevations. You're having a melt up in gold. You're having a melt up in gold miners. If you take a look at the price action of that, it's near vertical on a monthly basis. You don't really have that in the S&P yet, but you are seeing it in other asset classes as well. So you are seeing melt-ups in certain asset classes, but it hasn't spread across all the broad markets yet, but that's very likely could happen if you kind of keep this momentum going.
Yeah, let's touch on that for just a second, if you don't mind. Sure. So we've had some questions from clients, and we were talking about this yesterday in our investment committee meeting, at essentially looking at or thinking about replacing fixed income with gold. And what are your thoughts on that? 'Cause I've got a pretty good idea here. I don't think we're going to disagree on this one.
Well, it's fine. It's not a great idea. The reason is that gold doesn't pay interest, right? Yeah. So there's no interest income coming from it. It doesn't pay a dividend. So it's fine. It's a pure risk asset. So you're replacing a risk-off asset with a risk asset. And this is just a function of psychology, right? Because bonds haven't been rallying that much this year. Gold has been going up. And so now it's like, I want to buy the asset that's making me more money. And everybody tells me that gold is a safe asset, but it's not. There's been very long periods in history where it declines in price for a very long period of time. So again, it's just because it's a function of the dollar. So again, it's okay. You know how you want to manage your fixed income side of your portfolio or your safe side. It's like people putting Bitcoin in there. It's like, I'm going to replace part of my bond portfolio with Bitcoin. That's great, but you're replacing a stable value that's guaranteed payment with one that's not guaranteed value. In other words, if I own bonds, they're going to mature at face value. Doesn't matter what happens over time. There's no guarantee that the price I pay for gold or the price I pay for Bitcoin today will be that price in 5 years or 10 years. It could be a lot lower. It could be higher, right? But that's the difference between a risk asset and a safe asset. A risk asset is I'm betting on a price appreciation. A safe asset says, I'm going to give you all your money back at some scheduled point in time. Well, and those are the differences.
Well, and that's historically why you would put that inside of a portfolio, is that you want that diversification, number one. Most people do. And you want some type of historically non-correlated asset. Now, 2022, that's the exception to the rule, right? Worst year in bonds since 1788. There was no place to hide but cash. But in an environment like this, unless you think we're going to have, lower growth, higher inflation that keeps those elevated, those rates, or you think that, hey, everything's going to run and they're going to have to come back, switch gears and increase interest rates, then there's probably an argument that bonds are much more attractive now than they have been in quite some time. Especially if we're assuming for longer term rates coming down, if we are seeing slower growth, which is exactly what we're seeing at the moment, and we're seeing unemployment trickle down, I would expect that we would see rates that would follow. Unless that we just really, we hit some momentum here, we see this change. And that's the other argument too, talking about what a lot of the talking heads are thinking, is essentially that we are going to see that second half of the year pick up. Mm-hmm. And that may or may not be the case. Job numbers don't suggest that.
That's correct. And that's what everybody's betting on, right? And one of the other big things is that they're talking about tax cuts. It's like, the tax cuts are going to help fuel the economy. We didn't have tax cuts. All we did was extend the previous tax cuts. Well, those were already in the economy.
Correct, but I think what that did is it allows executives, it allows business owners, it allows people to make better plans moving forward. Versus, most people can't. It's not worth what they're what the paper they're putting it on, because the uncertainty. And we've talked about how markets don't like that uncertainty, but yet here we are with tariffs they seem to have made peace with. But that's just one of the things that's the elements that's out of the way, right? We thought there were three big things this year.
Correct, right? But the thesis is that tax cuts are going to help buoy profit margins.
Correct.
But the tax cuts are already in there. So there was no change to the tax cuts. It's going to increase profit margins. Now, it's just, I do agree with you, though. It's just the certainty that the tax cuts are going to remain. Yeah.
Well, it allows us as planners to plan that much better, to say, okay, now our back's not against the wall. We don't feel like we have to do, large amounts for Roth conversions or distributions in like this year per se, because we know that it's going to be here for a little bit longer, right? They did make that tax code permanent. The other aspect was the deregulatory aspect, which seems like that's really ramping up and is interesting, because I thought that was probably the lowest hanging fruit. Mm-hmm. That would have been very easy for them to do. But he's gone about this, his second term, President Trump has, much differently than the first term in that sense. And then obviously the tariffs, which, still up in the air, but the market has really made peace. I mean, if we go back all the way to when, everything happened, Liberation Day, to today, the market seems to just done a complete 180 here. It doesn't care. And that's what's interesting to me, in the sense that, something that was such a big deal. Now, obviously, it's had time to digest it, to understand it. What is the overall impact? And I think we're seeing a lot of that foreign investment that's coming here. If we look at productivity and like new starts for plants, like manufacturing, it's up 3x. And so that, I think, is really interesting to see of what that has sparked. Now, is that enough? Now, what do you think if you take out the infrastructure growth, you take out data center, all this investment here, do you think the economy's growing?
Right.
I mean, probably not much.
No. Well, again, this is also one of the big things, right, is that we're going to have this big boom in productivity because of AI. And there's a lot of logic to that. Yep. But the issue that nobody's really wrapped their head around that, and I don't know the answer, neither does anybody else, is what does AI do for employment? is AI going to increase employment and put more people to work, or is it going to decrease employment by increases in productivity? And the big factor about that is just what I was showing earlier this week. If you take a look at full-time employment as a percentage of the working age population, or take a look at full-time employment as a percentage of those that are actually working, that's been declining fairly sharply. And there's a big correlation between that full-time employment measure and economic growth. And if full-time employment continues to drag, you're going to get slower economic growth. And because full-time employment is what generates economic activity.
Yeah.
And I think this is the one detachment. Everybody's very excited about AI going, oh, this is great. It's going to provide all this productivity for businesses. Yes, it's going to make businesses more profitable. But it's great to be more profitable, but I got to have, at the end of the day, I can have more profitability through productivity. I can lay everybody off in my office, right? And it's just me and Brent and Danny using AI to run the business. But if nobody's buying our services, then it doesn't matter how profitable we are. And so for a lot of companies that depend on product sales of some sort, if people aren't buying their product because they don't have a job, it's going to be very hard. I may have 60% margins, but if I don't have any sales at the end of the day, that's going to be the problem for economic activity and for, at the end of the day, profits.
So it sounds like we could see two different economies essentially, right? Wealth gap continues to increase.
Mm-hmm. Well, that's it for certain.
But even in that environment, if you could reduce the cost, I was looking at some studies saying that just assume the average manufacturer worker is getting paid $25 an hour plus benefits, all the rest of it. They think by 2040 you're going to be able to have, these humanoids, the robots. It's going to effectively cost about $5 an hour to run.
Mm-hmm.
That's a big difference. So even if you had diminishing sales just because of your increase in profit margins, it may not impact stock price all that much.
It's possible. That's
something we've never seen. We've never been there.
Right. No, this is just something, but this is what everybody's trying to guess about.
Yeah.
And this is the problem with all the calls for, a major market crash. Look, stocks are going to correct, right? And again, a 3 or 5, 10% correction in stock prices wouldn't be surprising at all. 10, 15% would not be surprising at all. But for people that are calling for, hey, we're about to have the next, great bear market, it's going to be a 50% crash, you got to get out of the markets now. Just be careful with that because we don't know what the future of a lot of this stuff is. And what we do know is that we have a lot of money flow coming into the markets. People are chasing assets and they're chasing every asset on the planet. Now that's dangerous. We've seen these types of asset chases before. We've seen periods where gold has gone up very, very sharply and then had a 60% correction over time. It's gone up sharply and had a 50% correction time and time again throughout history. Stocks have gone up tremendously and had 50% corrections. We've seen Bitcoin have 50% corrections, after big runs. We know these things happen, right? But we don't know when they'll happen and we don't know what will cause them. And that's going to be a function of trying to just navigate the markets. And everybody's expecting, we're going to have this big 50% correction. Yeah, it'll happen. But the question is always, when will it happen, right? Yeah. Do I get out of all these asset classes today? Do I sell my gold today and our all-weather model? And do I sell all my stocks today in our equity model? No, because markets are still going up and we want to participate with that. But we do need to be aware that risks are building. We just need to be aware also that we don't have an idea about the timing. And that's where we're going to be. That's why risk management's important. That's why paying attention to the markets is important. And not getting swept up into narratives, either bullish or bearish, right? Just, leave these narratives at the doorstep. If it's a narrative about how the markets are just going to go off to the moon forever, then that's not a good narrative. If the narrative is everything's going to crash and burn, that's not a good narrative. We know that these things will go up and down over time, and we just need to manage that risk.
Yep. So last week, you and I talked a little bit about, markets in general and, how back until probably 2020, we had a lot of people that would call in and be like, hey, we have been completely cash since 2008. How do we start to get into the markets? And Lance, I had 2 of those calls this week. I'm serious.
Really?
I have not had one in some time like, hey, I've got the majority of my funds in cash. And, a lot of people arguing, well, we talked about money on the sideline, like what that really means. Like, is there truly money on the sideline? Because that money, guess what? You're buying that stock from somebody else, so you're just trading places. So with that being said, though, I think the momentum of it is important, like how quickly people are moving, kind of what you're talking about. But on the flip side, I have not had that type of conversation in a bit where it's just like, hey, I've been out. I feel like it's time to get in. And that's the exact conversations that we've seen prior to some type of dip. Because they feel like, oh, I am missing out. And the first person I talked to said, I have FOMO. Like, they knew it.
Yeah.
And they're like, I have FOMO. And I don't want to look back in another year or two and just be so wrong. And I'm like, well, what are you getting right now? Well, I'm getting 4.1%. Okay. Can you sleep at night? Yes. Okay. Well, do you need these funds anytime soon? No. Okay. So, like going through that process.
All right.
And essentially, they were, even though they don't need these funds, they're like, I need to get it. So, what do you say to somebody like that?
Let's get in.
Yeah, but I think there's a big but here.
No, there is.
And you need to be prudent with it.
Right.
And if you don't necessarily need it, because here's my thought on this is that, okay, this isn't, make or break right now. Yes, you feel a little bit of FOMO. All of your friends are telling you how well they're doing. I can assure you, yes, probably many of them are, but they also don't ever tell you about the things that they're not doing well in. Mm-hmm. So take that stuff with a grain of salt.
Well, and then the other way is like, look, let's just assume you're 100% cash, right? And you're having FOMO and you want to get into the markets. It's never a bad time to buy into the markets. Never, right? It's always a good time to buy into stocks. But the question is, how do you do it? And so,
correct.
This is where you just start, take whatever dollars you want to invest, break it up over 12 months, and just do a little bit, or you go 24 months, you go 36 months, pick whatever time frame you want, but just buy a little bit, right? And buy a little bit this month, a little bit next month, and then hopefully we'll get a correction along the way. You buy into the correction.
Yep.
And then you buy coming out of the correction. And, then you kind of get a good kind of average cost basis and you're in good shape. Now you're in and you can just kind of let the market start to work for you. The hardest part always, and Danny will tell you this, is that we have a process when you become a new client with us, is that this is how we work in. We buy part of the portfolio today and then we wait for an opportunity for the market to correct and we'll buy in the rest of the portfolio and try to kind of dollar cost average a bit into our portfolios over time. So we're just not buying it all at once. Most firms you go to, you give them your money, tomorrow you're invested, and it really doesn't matter what the market's doing. We try to be a little bit more prudent about that, but there is no good way and no guaranteed way to just get into the markets. If you're all in cash, getting into the markets is the most difficult process to do. It's just you've got to either got to bite the bullet and buy it and hope you're right, or you've got to work your way in over time. The mistake that a lot of people make, though, is they go, well, I'm going to wait for the correction. I'm just going to sit in cash, and when the market corrects, I'm just going to wait. And then 2008 happens, they don't buy because everybody tells them the market's going to keep going lower, so I'm not in. And then the market starts rallying. It's like, okay, next dip I'm going to buy, but the next dip comes in 2010 and they don't buy that because, some other reason. And then the market rallies again without them. And this becomes a psychological hangup. I don't ever get in because there's always this fear that the markets are going to go lower and I'm not going to buy the bottom. And that's always the problem. And we got to get past that and just start going, okay, look, I need to get into the markets. The markets are going to rise over time because of economic growth and inflation. Are there going to be hiccups? Yes, there are. I have to be able to work my way through that. That's where risk management comes through. But I have to get into the markets. And so just start just dollar cost averaging your way in. Buy, pick your stocks that you want to own, buy a little bit of them. And then when they have little declines or whatever, or each month or each quarter, however you want to approach it is up to you. Then buy some more and just keep working your way into it over time. And you're going to buy some stocks, some of the stock prices you're going to buy high, some you're going to buy a little bit lower, but hopefully you'll get a good, decent average cost basis over time.
Yeah, I think that's the struggles that they see, like how well something is done. And that makes them want to get in, right? Inevitably, that's just human nature. But they also like, oh, this is expensive. And we don't always onboard or get into the market in that manner. If valuations are much lower, yeah, maybe we're going to say, hey, let's flip the switch, let's go. Or if you're already fully allocated, but if you're in cash, that process Lance just described, that is the challenge because number one, if you're onboarding slowly, you're going to miss out if the market continues to run. You're going to underperform, but you've got to make peace with that. Now, if the market declines, you've got dry powder you can put to work. And I think that's the key, right? Using volatility to your advantage. So, that is almost exactly, though, is kind of funny. So I said, hey, have you ever looked at SimpleVisor? Was a conversation I had with this gentleman. And he said, yeah, I'm on there. I can't keep up with the trades, number one. And number two, the stocks have done very well. So how do I buy into them? I said, that's funny because we would have had the same conversation 3 months ago, 6 months ago, because in general, a lot of these companies have done very well this year. And I think that is the challenge, trying to onboard funds, get into the market. But, just going back to that kind of the dynamic that people are beginning to say, hey, I've got to be in the market. And somebody from cash, two people, that's not something that we've been hearing as frequently. And maybe that'll become more, more common. I don't know. But, if you're trying to figure out how to get onboarded, go to realinvestmentadvice.com, go to ask a question. We'd love to help you guys. Give you some ideas, help you. I mean, this is what we do.
Well, and again, everybody just assumes that, when you're in a bull market for something, it's just going to last forever.
Yeah.
And just had a comment in chat going that we don't believe in the bull market in gold. No, we absolutely believe there's a bull market in gold right now. Excuse me.
Clearly, just look at the numbers.
Exactly. Just look at it. But again, when you take a look at these things, you have to understand that there is risk that you have to manage over time. And we often forget about that. We get all swept up. It's like, oh, this is the bull market, and we're going to have this forever and ever, and it's going to be awesome. All bull markets end. All bull markets end. At some point, something will happen. The dollar's going to rally strongly at some point. That's going to suck the wind out of gold at some point. That will happen. It happens repeatedly throughout history. And when you have deviations like you have currently, those are all kind of good warning signs that you're very late into the, and this is for people finally after 20 years, they're finally having a rally in gold miner stocks, and they're like, oh, gold miners are finally rallying. They've been hoping for a gold miner rally for 20 years, finally getting it. Just understand that there's a risk to that. And with all bull markets, and it's very fascinating to me, Danny, because again, the people that are finally getting this rally in gold that they've been hoping for, finally you're getting this big push in gold price. You have this bull market in gold. Gold isn't overvalued, but stocks are overvalued. So we're going to have a big stock crash, but we're not going to have a gold market crash. That just doesn't make any sense.
When nobody's selling it.
Yeah, exactly right. Exactly. And so this is a chart. This is a long-term monthly chart of gold. Going back to 1970. And there are only 4 previous periods in history where gold has been 3 standard deviations above its 5-year moving average. And the first correction was 60%. The second correction was 50%. The third correction was 50%. You only had a 20% correction during the 2022 sell-off in the markets. It just went nowhere. It basically corrected 20%. Gold price just went nowhere. You have never had a vertical extension like this since 1970. And the risk that you run is that this vertical extension will end. And you very rarely have been this, you have to go back to 1970 to be this overbought on multiple levels in gold. So again, I'm not saying that we're not in a gold bull market, because we absolutely are in a gold bull market. Just understand that the technicals don't go away. This rally could continue further. We could certainly see gold go higher from here, absolutely. But eventually, all dynamic moves like this is the clearest view of a melt. If when people talk about, oh, stocks are in a melt up, that is a melt up in gold. Right? That's what a melt up looks like. When you go basically go vertical in a price movement, that's a melt up. That's when you have just outstanding demand for a particular asset and you're driving it higher. The narrative doesn't matter. Whatever the narrative is that's causing it, that's a melt up. You don't have that type of vertical extension in stocks right now. So again, but stocks are overvalued too. And again, all asset classes are in a lot of cases, but this is the thing. This is the importance about understanding risk management. It's about not getting swept up into that hype and that hope and that narrative. It's just understanding what my risk is. Do I have the potential to give up I've made a lot of money with gold this year in our portfolios. Our all-weather models are just performing outstanding this year because of gold and because of the gold miners that are in it. That's been a fantastic trade. I don't want to give all that back up. And I certainly don't want to give up 50% of my gains when you have the next correction when it comes, right? So it's just important to keep and focus what our job is. Our job is to manage our capital and manage our risk. I love every asset equally. Doesn't matter what the asset is. But again, I want to find the best opportunities to buy it, but also want to understand the best opportunities to sell it.
Well, and I think that's important what you just said. You love every asset equally. We don't care what the asset is. If it's a good asset, we have no problem buying it. And I think that's a problem too, especially when it comes to some of these more, I'm not going to say a fringe investment because it's not a fringe investment by any stretch, but more of an outlier. What does that chart look like if you overlay the S&P?
Over that period?
Yeah. Well, you're talking about 1970s, right? It's the last time you've really seen gold shoot up like this. And that's what's interesting. Gold is always sold kind of as a fear trade. It's a hedge against inflation. It's a hedge against market declines. It's a hedge against, we're out of food and water.
Right.
Whatever it may be. It's a great insurance policy is what the idea always is. And, yeah, we can make those arguments. I'm not discounting that. But there are, I think we could go a lot deeper. We could probably spend a whole show on that. But if you look at it versus, okay, this is that non-correlated asset is what you're assuming. Mm-hmm. Well, right now, that's not the case.
Right.
That's really not the case with many assets.
No, that's right. Because when you have markets that become more FOMO driven, like we're having now, you start seeing correlations in assets go to one. Gold should technically have a near negative correlation to stocks. Historically, it does.
Yeah.
Because it tends to be a risk-off asset, right? It's a safety trade. It's a fear trade, whatever it is. So when stocks are collapsing, money runs into gold. But that's not the case right now. Correlations between stocks and gold and Bitcoin and emerging markets and small caps and mid caps are all basically heading towards one. And the problem with that is ultimately if there's something that scares the markets, money's going to flee all assets at one time. And that's where we kind of saw 2022. We saw that very similar setup. There was no safe place to hide. Bonds didn't work. Gold didn't work. Stocks didn't work. Nothing worked in 2022. Only cash was the safe haven.
And that should have been a year. Ideally, gold should have worked really well.
Should have worked great.
Yeah.
Because you had inflation running. You had the Fed hiking rates. It was a beautiful environment for gold, and it didn't work.
Yeah.
But, yeah, so anyway. But bringing all the point is bringing all this back to our original conversation. There's a lot of expectation, and again, when you start looking at, asset prices in general, you're seeing these melt ups in the markets, and there's no denying that you're having a melt up in the markets. Again, here's a I have to change this to performance because to get comparative, the red line's the S&P, the blue line is gold prices. You can see both of these asset prices have gone near vertical over the last, really since 2022, that dip, that really small dip, so you have the kind of first big mountain, that dip just to your left, that's April. The next dip is 2022. That little small dip, that's the pandemic. That's that 35% decline that we had during the pandemic in the S&P. So, and the magnitude of these drops, you can go back and look at the dot-com crisis now, and if you look at the markets now, you look back at the dot-com and the financial crisis, and it goes, those were nothing, right? Those are just small dips. Those were 50% declines in the markets. So, but again, you can see that how these asset prices have now gone near vertical. That's something that we saw. You have to really kind of zoom in to 1999. But you go back to 1999 as a good example. You had the same type of vertical price movement in 1998, 1999. So you are getting a melt up in asset classes, and you're very overbought in many of these things as well. Again, this doesn't mean you're having a financial crisis tomorrow. Doesn't mean a 50% correction tomorrow. Doesn't mean you have to get out of the market today. Not saying that at all. Just saying that you've got a lot of money chasing this market. There's a lot of money chasing this market. We have what's going on right now. It's called the breadth thrust, which is that you have this breadth of buying that's coming in. is something that tends to support markets for quite some time. You've got a lot of exuberance, a lot of buildup in the markets. That's very bullish. The bullish backdrop to all asset classes right now is very, very strong. So again, if you're buying an asset because, I think this asset is going to be okay if stocks completely fall apart, you need to rethink that strategy, because when everything runs to a correlation of 1, and you're having a melt up in basically every asset class at the same time, that becomes problematic. Because when money does look for safety, it's going to leave all those assets at the same time because the correlations are 1, and it's going to go find something else. And right now, cash is about just the only thing that's going to be safe at this point.
And if we continue to cut interest rates, cash is not going to look nearly as attractive as it does today.
Which may bode well for bonds, but we'll see. Yeah.
Well, and so the other thing with that is, so if you're onboarding, think about it like this. We got to think about it in long term. Number one, Lance mentioned, we look at that screen of that chart, and these big market downturns are a blip in the screen. Mm-hmm. But we have to understand where we are in a life cycle. If you're still accumulating, you're using those dips to your advantage. If you're retired, we've got a problem potentially. And those are things that you need to figure out within your plan. If we're allocating cash right now, and what happens over the next couple of months, the next year, is probably just a blip in the screen. But at the end of the day, we'll look back in 5-10 years, and I think you're likely going to be much better off. Now, if you're just going to buy one asset, stick it, forget it, I'm not sure that's the best strategy right now. You need to be nimble. You need to understand where you're at. But it is interesting when you put that in context, and this thing can run for a while.
Yeah. Yeah. The great thing about momentum is it's like a train.
Yeah.
Right. You can't, when you have these big freight trains that are going down the tracks, it takes them miles to stop. So, because you've got so much force behind, so the engine's pulling the train, but you've got this mile-long stretch of cars behind it. Well, when the locomotive tries to stop, all of a sudden you get the momentum of all these other cars behind the train pushing the engine down the track. And that takes a very long time to slow that train to a stop. And it's very much the same type of analogy with the markets, in terms of you've got so much momentum in the markets that nobody wants to even think about the potential that, this could reverse. And particularly when we're making a lot of money, this is the pushback I get about gold, right? And if you own a lot of gold right now and you're a big gold bug, listen to what I'm saying to you. I agree with you. Just be aware that you're in a narrative about why gold prices are rising. There's a lot of momentum behind gold prices. As an example, because I'm getting a lot, and the reason I'm using gold right now is because I'm getting pushback in our chat, which is fine. I just want you to understand my position so we can have the same agreement on what we're talking about. Let's have a discussion. You've got a lot of momentum of buyers behind gold prices pushing it up. What happens when that momentum begins to shift? Because all it takes is one guy to say, I'm selling. And then another guy goes, Danny sold, maybe I should sell too, because Danny's a really smart guy. And then you get some institutional selling. And again, it starts out very slow, but like slowing down a locomotive, you've got all the push and the momentum by the retail buyers pushing it higher, but the institutions start selling first. Always the case. Institutional sellers will start to sell first. The central banks will begin to sell. And it'll be very slow, but it'll be a very mild rotation out of gold, and it'll be very slow to start. But then that momentum begins to reverse and pick up in the other direction. By the time you realize that, that's where you've now given up a big chunk of your gains. So just that's all we're talking. That's just how market dynamics work. And it's always the case throughout history. Nothing's going to change that in the future. This time isn't different, because that's just the way market dynamics operate. And it's not just gold I'm talking about. It's gold, it's gold miners, it's Bitcoins, it's stocks, it's bonds, it's every asset class operates exactly the same way. So just as long as you understand that, then, own any asset class you want. Just be careful and understand that market cycles and how market dynamics work.
There's two things that you can't talk about, Lance, without getting grief.
Yeah, I know.
It's gold and crypto.
Yeah, exactly.
I mean, there is such a passionate base about it.
It's a religion.
It really is.
But again, it's always fascinating to me, right? Those asset classes can't be overvalued,
Never.
But stocks can.
Yeah.
Right? No, every asset class can be overvalued. Every asset class can be in a bubble. It's just, but again, be careful of narratives.
And I get it. I mean, there is a passionate base for certain about each of those asset classes. But it's, it's funny because sometimes you never hear those people wanting to sell, and you can always still buy new assets of it.
Mm-hmm.
And it is kind of counter market trend is what a lot of that narrative is. And that's understandable as well. But, this thing's continuing to run. Now, what about the cycles? We've seen, dips, things really about since 2018. We could probably make an argument that markets were expensive. But we get these quick drops. And we're continuing to see that, right? 2018, you had the worst fourth quarter since the Great Depression. 2020, obviously COVID happens. 2022, interest rates were up. Markets dipped considerably. It seems like every other year we're getting kind of that push.
Well, we'll get something.
Yeah.
Again, what causes it is the unknown part. It won't be rate cuts. It won't be, anything else. Could it be the onset of recession? Yeah, but that'll be after the fact. It'll show up, though. We'll start to see a deterioration in forward earnings guidance and a deterioration in profit margins. And when we begin to see that begin to materialize, that's where the risk of the market comes into shape. And we're starting to see a little bit of that in the small mid-cap area, but we haven't seen that deterioration just yet in large caps, and particularly in the top 10. And if you take a look at S&P earnings, there's basically been no growth in S&P 500 earnings in the bottom 490 stocks. The top 10 have been driving all the earnings growth. So if we begin to see a deterioration in earnings growth in NVIDIA and Microsoft and Amazon, those type of things, we start to see a slowdown there. That's going to be your big risk for the markets, particularly because so much money is hiding in those particular stocks.
Yeah, no doubt.
Yeah,
it's going to present a unique challenge over the next year.
Make sure and get registered for tomorrow's Savvy Medicare Planning. It's Thursday it's tomorrow, right, at noon on September the 18th. Make sure and register. You just go to the website, realinvestmentadvice.com. The banner is right there on the website, right at the top, and just click that button. You can register for it, but it's going to be all about Medicare, understanding enrollment periods. The Medicare window is coming up. So if you're 65 and need to get on, or about to be 65 and need to start to think about needing to get on Medicare, I'm very close to that. Maybe tomorrow I should attend this webinar. Might be helpful for me as an older guy. But yeah, anything you need to know about Medicare, there's so many kind of tricks and traps to Medicare. Make sure you're doing it the right way. Danny and Richard are really, really good at this, so they can help kind of walk you through that. That's tomorrow at noon at the website, realinvestmentadvice.com. Our latest blog post is out. Michael Leibowitz back tomorrow. We'll talk all about the Fed, what's going on with the Fed, what to expect, see how the market reacts today. We'll get with you on that tomorrow. Be sure to like and subscribe to the channel. We appreciate it a lot. It certainly helps us out. And hey, send your comments, suggestions. Give us ideas for the show. Whatever y'all would like to see. Love to do more of that. So be sure and reach out to us and let us know that as well. Realinvestmentadvice.com. Have a great day.